Welcome to the Global Commerce Academy, your go-to for free CMA USA classes. Today we start external financial reporting decisions, the foundation of accounting and reporting. Every business, from coffee shops to Apple, tells its story through financial statements, revealing how money flows and what it means for the future. We'll break down the four main financial statements and show how they fit together to tell a complete story. Let's begin your journey. Let's get right to it. What are financial statements? They're formal records of a company's financial activities, like a business's report card. These documents summarize thousands of transactions into a few key reports. Their main purpose? To provide information for decision-making. Investors, banks, and managers all rely on these statements to make informed choices. Financial statements create transparency and trust, making business less risky and more accountable. Without them, investors would be guessing and managers would be flying blind. They impose order on financial chaos and provide a basis for accountability. Mastering them is your first big step in the CMA journey. Let's see what these statements look like. In business, understanding financial statements is essential. There are four key statements: the income statement, balance sheet, statement of cash flows, and statement of changes in equity. Each tells a unique part of a company's story: profitability, financial position, cash movement, and changes in ownership. Together, they form a complete financial picture. Mastering these statements is crucial for any CMA. Let's dive in and unlock the secrets behind the numbers. The income statement, also known as the profit and loss statement, is a fundamental financial document that measures a company's performance over a specific period of time, usually a quarter or a year. It provides a detailed summary of how much money the business brought in, what it spent, and ultimately, how much profit or loss was generated during that period. The statement begins with revenue, often called the top line. This is the total amount of money earned from sales of goods or services before any expenses are deducted. Revenue is the starting point for understanding a company's financial health. From revenue, the cost of goods sold, or COGS, is subtracted. COGS includes all direct costs related to producing the goods or services sold, such as raw materials and labor. The result is gross profit, which highlights how efficiently a company turns resources into products or services. Next, the company deducts operating expenses. These include salaries, rent, utilities, marketing, and other day-to-day costs required to run the business. After subtracting these, we arrive at operating income, which shows the profit generated from the company's core business activities before considering interest and taxes. Operating income is a key indicator of how well the company's main operations are performing, separate from other financial activities. After accounting for interest expenses and taxes, we reach net income, often referred to as the bottom line. Net income represents the company's total profit or loss for the period, after all expenses have been paid. Net income is the ultimate measure of profitability. It's what remains for the company to reinvest in growth, pay dividends to shareholders, or save for future opportunities. This final figure is crucial. It determines what's available to reinvest in the business, distribute to owners, or set aside as reserves for future challenges. Every line on the income statement tells a unique part of the company's financial story, revealing strengths, weaknesses, and opportunities for improvement. As a CMA, your role is to analyze these numbers in depth, uncover insights, and make strategic recommendations that drive business success. Understanding the flow of the income statement is essential for effective business analysis and decision-making. The income statement is your first and most important tool for measuring a company's financial success and guiding its future direction. Now let's move on to the balance sheet, another vital financial statement. The balance sheet is a snapshot of a company's financial position on a specific date. It's built on the equation assets = liabilities plus equity. Assets are resources the company owns, listed by how quickly they can be turned into cash. Liabilities are debts or obligations, split into current, due within a year, and non-current. Equity is what's left for the owners after debts are paid, capital contributed and retained earnings. The balance sheet must always balance, showing who has claims on the company's resources. If the company sold everything and paid its debts, equity is what remains for owners. This statement reveals a company's stability and financial structure. It's essential for assessing risk and value. Next, let's follow the money with the statement of cash flows. Profit doesn't always mean cash. Enter the statement of cash flows. This statement tracks cash inflows and outflows over a period, showing how money moves through the business. It's divided into 3 sections: operating, day-to-day business; investing, buying, selling assets; and financing, loans, stock, dividends. Operating cash flow shows if the core business generates enough cash to sustain itself. Investing cash flow reveals growth plans, buying equipment or selling assets. Financing cash flow shows how the company raises money or pays it back. Analyzing all 3 gives a clear picture of cash health. A company can be profitable but still run out of cash. This statement explains why. It's vital for understanding real-world financial strength. Cash flow analysis is a key CMA skill. Now, let's see how owner's equity changes over time. The statement of changes in equity tracks how the owner's stake in the company changes during a period. It starts with beginning equity, adds net income, and subtracts dividends paid to shareholders. Issuing new stock increases equity, buying back stock or losses decrease it. This statement links the income statement and balance sheet, showing how profits and decisions affect owner's value. It's essential for understanding how management choices impact shareholders. For CMAs, this statement reveals the story behind the numbers. Let's look at the rules that keep these statements reliable. Financial statements must be reliable and comparable, so accountants follow key principles. The going concern assumption means businesses are expected to keep operating, not shut down soon. Accrual accounting records revenues when earned and expenses when incurred, not just when cash changes hands. This gives a more accurate picture than just tracking cash. Consistency means using the same accounting methods over time, making comparisons meaningful. Comparability allows users to compare different companies thanks to standards like GAAP or IFRS. Materiality means focusing on information that could influence decisions. Ignore the trivial, report the significant. These principles ensure financial statements are trustworthy. As a CMA, applying these rules is part of your job. Let's wrap up with tips for exam success. For the CMA exam, don't just memorize, apply what you learn. Understand how the statements connect. Net income flows into equity and cash and equity balances appear on the balance sheet. Practice calculating missing figures and analyzing scenarios. Be comfortable with ratios like current ratio and debt to equity, and know what they mean for a company's health. Use real-world examples, read annual reports and relate numbers to business news. The exam tests your ability to interpret and analyze, not just define. Engaging with real financial statements will deepen your understanding. Mastering these skills makes you a strategic business partner, not just a bookkeeper. Keep practicing, stay curious, and you'll succeed. We'll dive deeper into financial analysis next time. Thanks for watching.